And so that sort of pushed us into a late cycle inflationary dynamic, which we haven't really seen since, since the 80s, maybe that 90s cycle, was a modestly inflationary cycle. But really since the 70s and 80s period, we hadn't seen a real inflationary oriented cycle. It's not to say that what we're experiencing right now is exactly akin to the 70s or the 80s, but that sort of dynamic late cycle inflation and the central bank tightening in response to inflation is an unusual circumstance for basically all of us in our professional careers.
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Bob Elliott, who used to work with Ray Dalio, the billionaire hedge fund investor, to share his thoughts on investing. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? To have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want? To be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and bring balance to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. While you're there, you can sign up for a monthly email where I share the best articles I read this month, let you know about upcoming episodes, and share a little wisdom. You can also listen to coaching calls under the Coaching Calls tab. I also share the most interesting articles I read every week on Facebook at facebook.com/Richer Soul. And there's also a Facebook group where you can ask questions and interact with other listeners. It's only fitting that our quote be from Ray Dalio. I think the first thing is you should have a strategic asset allocation mix that assumes you don't know what the future is going to hold. Here's the bottom line. We don't know what the future is going to hold, but we have one of his past macro investors on today. The reality is it's hard to invest. And the older I've gotten, I realized how much I didn't know and how much harder it is. Here's the reality of it. The history of the markets of the last 40 years are very likely not going to be the future of the next 40. And I don't think most professionals realize this and understand what to do in an inflationary environment. As a matter of fact, in a couple of weeks, we're going to have an episode just on that as well. Way back at the beginning of this podcast, I laid out a framework for life, including money. The money part is episode 7. I said I wasn't the expert, but I bring them to you. Today, we have a strategist from Bridgewater Associates, which is led by Ray Dalio. If you don't know that name, check out Ray's work. He's got great videos on what's happening economically and the changing world order. We're going to hear from an expert what that may mean for you. There are drivers in the economy, and we're at a time most people have never lived through. And most experts are too young to live well. A lot of what we're going to talk about is somewhat predictable, but we don't know how it's going to play out. Everyone should understand the forces because it's going to affect your ability to create wealth. I want to share some of the power of compounding. If you take a single dollar and you double it every day for a month that has 31 days, you end up with more than $1 billion. Think about that. In the beginning, it's really boring because you have $1, then you have 2, then you have 4, then you have 8, and you go, whatever. Even at day 15, you've barely broken $10,000, I think. But when you keep doing it, and when you keep going, you end up with massive progress. Now, we can't double our money every day, but maybe we can work towards it in a year. And even doing it in a year is hard. But the more we try, the more success we're going to end up with. And the reality is we don't need $1 billion. I know a lot of people who save 30 to 50% of their income. They just start small and they keep growing. The reality is when you have screw you money, you have the freedom to work on what you love and do and get paid more. And it's really not as hard or as much as you think you need. Our guest today is Bob Elliott, a macro investor with decades of experience, including working at Bridgewater Associates, the world's largest hedge fund, where he created many of the strategies in the flagship Pure Alpha fund. During his 15 years at Bridgewater, Elliott ran Ray Dalio's investment research team, authored hundreds of Bridgewater's widely read daily observations, and directly counseled policymakers at the Fed, Treasury, ECB, PBOC, and others on macroeconomic and investing issues. In early 22, he started Unlimited, a startup ETF company making diversified low-cost index ETFs of the 22 and 20 investment strategies available to every investor. His first product is the HFND ETF, one of the fastest growing, actively managed independent ETF launches of the last few years. Let's meet Bob and learn from him. Welcome to Rich Your Soul, Bob Elliott. It's great to have you join us today.
Thanks so much for having me. Looking forward to it.
As am I. We always like to start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
I grew up as a middle-class kid in the Midwest. And, I think in many ways, my father was an entrepreneur through a bunch of different ideas through his career, and, sort of instilled in me that entrepreneurial spirit. I like to say I was the last kid to have a proper paper route, slinging papers on Thursdays and Sundays in my neighborhood, and, had all sorts of different hustles with the basic idea of, I needed to earn whatever I was spending, even when I was a kid. And so that took me to a whole bunch of different places, a whole bunch of different odd jobs, from shoveling driveways to cutting grass to cleaning offices and such. And I think, for me, the primary lesson was that you got to work, you got to work hard for your money, right? Things don't come they don't just come to you. You've got to earn them. And I think that was a pretty important, core life lesson that has stuck with me to today.
So was your dad instrumental in teaching you that? Was it because you watched, or was there some innate drive that made you go out and do that?
I think a big part of it was being in an environment where like the experience of many entrepreneurs, sometimes, things are great and sometimes times are tight. And particularly when times are tight, whether I was going to have things that I wanted as a kid, even as a kid, whether it was, baseball cards, sticker books, or candy bars. There were certainly periods of time where my family didn't have the extra money to be able to spend on that. And so it came down to, either I was going to earn it or I wasn't going to have it. And so, that was the basic drive, is that if I wanted something that wasn't, that my parents, who were great at giving me the basics and supporting my education and things like that. But if I wanted anything that was, beyond the basics, I was going to need to go out there and work for it myself.
It's funny. I hear these stories of people who grew up with entrepreneurial parents, and it seems to always be a roller coaster in that ride. It always amazes me. Like when times are good, nobody seems to put the excess aside. They just tend to live large, and then they deal with bad times, I guess.
Yeah, I don't know. The life of a small business in middle America isn't necessarily living large. Or at least for us, it wasn't living large. It was maybe a little bit extra is what it was in the good times, and it can be lean in the hard times. But it's interesting. You say that the life of an entrepreneur is a roller coaster. It's incredible how many children of entrepreneurs become entrepreneurs themselves. You know, there's something about the experience that is very fulfilling. And so, you know, even though it is a roller coaster and you've seen it yourself with your own eyes, the draw to it, it continues, it seems, in many cases.
And I get that. I think it might be the freedom of doing that. I don't know. It's funny because one of my kids is doing the work path and one of the kids is doing the entrepreneurial path. So I guess you never know. I can only see from that. But for people who have seen both, like they see what it means to have a W-2 job and then see then what it was like to have an entrepreneurial type of opportunity. I think for a lot of them, just that ability to see that makes them more want the freedom to do it the other way. And especially if they see success with it.
Yeah, for sure. I mean, I can tell you from my own experience that, you know, I've obviously had experiences, a meaningful amount of work experience in a more traditional job. Although when I started at Bridgewater, it was pretty entrepreneurial. It's a pretty small shop. But you know, I've gone through a process of working a more traditional job as well as working, you know, as an entrepreneur. And there's no question that working as an entrepreneur is a lot harder work, longer hours, harder work. But it is, I've at least found it very fulfilling. You know, I think part of it's that freedom, and part of it is the, you know, inspiration that you're building something that is, you know, not just part of a bigger, larger organization, but something that you're building for yourself and your family and the team that's around you.
That makes a lot of sense. How did you get involved with Bridgewater? In school, I was, I sort of did two different things. My academic training was actually as a botanist. A lot of my time in high school and college was as a doing pure science research and in botany. And I sort of came to the realization that being a laboratory scientist was not really the career that made a lot of sense to me. And at the same time, I had been doing actually a fair amount of nonprofit and development work around global health issues in the global South, and increasingly recognized how macroeconomic conditions really were really the driver of a lot of the bigger picture, you know, health and quality of life issues that you know, drove people's outcomes everywhere. And so that got me interested in macroeconomics, and coming out of school, basically said to myself, you know, Bridgewater as a macroeconomics shop would be a great place to essentially like get a master's degree in macro, right? And I thought I'd be there for a couple of years and, you know, pick up an understanding and then go on and do something else. And almost 15 years later, I was still there. I guess I would say it's beyond a master's. I mean, working with Ray Dalio and one of the largest investment funds in the world, and he has had tremendous success. I know he still puts out a lot of great content today about the entire world macro situation and how it's changing in all the different markets. So that's got to be an experience in and of itself.
Oh, for sure. I couldn't imagine a better place to build that sort of fundamental understanding of how macroeconomics work, how the macroeconomy and markets work. It's really, it not just was a great place to start a career and help build, Bridgewater from being a challenger asset manager to being the incumbent, but I think it also, it helped me become increasingly passionate about the macroeconomy. Like I really enjoy it in the same way. I think in the same way that I connected with the pure sciences around thinking about systems. If you think about biology is just a series of different interconnected systems that, eventually come together and get a plant, an animal, things like that. I think in many ways, I've been drawn, my sort of core interest in the macroeconomy was drawn from that perspective, which is, in many ways, macroeconomics is just a series of interconnected dynamics that are all playing out, and interacting with each other through time. And so that I think is very, very interesting. It's a very interesting problem. The other thing that's, I think, exciting about it, and if you talk to people who have done macro for a long time, is that there is always something more to learn. You will never solve, how the macroeconomy works. And so if anything, like the last 3 or 4 years has been such a good example of look at all the different dynamics we've seen and experienced and how different those were than the 10 years before that. And so it's a very, you show up every day, there's something interesting going on. There's new learning to be had. And I think that is the foundation of something that creates a persistent career rather than something that's transitory.
It's funny. When I look at things in reverse, they make a lot of sense. And I keep thinking to myself, I should have thought of that in advance because there'd be great opportunity to make money. So let's just kind of define some terms. What exactly is macro investing?
Yeah, I think macro investing is this idea that there are core drivers of the economy and of markets, things like growth and inflation, employment, things like that are the sort of fundamental building blocks that drive what transpires when you're looking at things like asset prices. So stocks and bonds and commodities and gold and things like that. And what macro really signifies is that as distinct from a more micro approach or a more individual security approach, is that instead of focusing on the particular attributes of, say, a particular company or a particular borrower, what macroeconomists and folks in the macro markets are doing is they're focused on sort of the aggregate asset price dynamics. So what's going on with the stock market in general, the aggregate stock market, the aggregate bond market, currencies, growth, inflation, things like that, rather than focusing on any particular company or industry.
And I think a lot of people have said, especially with stocks, just invest in the market, set it and forget it. And I think the last macro run we've had up until recently, it's been very favorable to do that for probably the last 30 years. It was, it just worked. You had some up and downs in between it, but overall, it seemed to work. Whether or not that happens going forward, we'll talk about a little bit more in regards to that. We'll see because I think the game is changing, and I don't know that everyone is aware of that. And I think that's a big part of what I think I want to bring awareness to. So within that macro, there's also secular cycles and there's also business cycles. Can you explain a little bit about them and why they are important?
When you think about actually what drives markets and economies, there's basically 3 big pieces. The first is productivity. And productivity is a very, very long-term cycle, which means, and all productivity means is over time, we're increasing our ability to produce goods and services. And as a function of that, we're getting wealthier and wealthier. And some of it accrues to labor and some of it accrues to companies. But basically what you see over, if you were to zoom out and look at the US over the last 150 or 200 years, what would you see? You would just basically see a straight line that goes up that's consistent with productivity. And similarly, that's what you would see in things like the equity market. A level below that, there are, of course, undulations around that very long-term trend of productivity. There's two big ones. The first one, which people are more familiar with, is the business cycle. The business cycle you can think about as a series of connected events that repeat over and over again. You have a downturn that leads to a decline in interest rates. That decline in interest rates then helped stimulate the economy. That stimulation to the economy and to asset prices then creates an upswing. That upswing has life to it. It's a self-reinforcing upswing to a point in which you have so much of an expansion that the central bank typically tightens, and that reverses the cycle. That's a cycle that we've been through. Most people have been through several times in their lifetime, and certainly in their professional careers, you will have gone through a number of those cycles. So things like the 2008 cycle, the 2000 cycle, the 1990s, et cetera, are typical business cycle type dynamics. And then overlaid in those sort of business cycle dynamics is often a longer term cycle, which is called the long-term debt cycle. And what that is over time, what happens is with these business cycles is that as people are increasing, as there's stimulation that occurs to the economy, people take on more and more and more debt. And what happens is over time, initially that debt, if you have essentially all income and no debt, it's fine. It's easy to take on incremental debt. But over time, eventually, what happens is people start to take on too much debt, whether it's people or the government. And that's essentially what happened with the U.S. households in the financial crisis. So they had taken on too much debt for their houses. And eventually you reach those limits. And that creates a downturn in the debt cycle, in the long-term debt cycle. And that's a challenging thing for a central bank, because a central bank's core approach is predicated on the ability to lower interest rates to stimulate activity, and that requires borrowing. And so if you have a situation where someone's borrowed too much, even if those interest rates fall, it's difficult to continue to borrow to bring the upswing in the cycle. And that's really what we saw in the 2008 financial crisis. Is we had a combination of a business cycle with reaching those long-term debt cycle limits. And that's why it was so challenging to get the economy out of the dynamic that we saw in the early 2010s, why it took so much stimulation, why the economy took so long to recover, is because we were having a business cycle downturn and a long-term debt cycle downturn.
So what I have noticed, and you kind of pointed them out, business cycles, I've always been told, are about 7 to 10 years. So 92, we went through a recession, 2000, roughly 2001 recession, 2008 recession. Oops, we missed one since then. No business cycle. And we'll deal into that a little bit deeper. How long do debt cycles tend to go up and down?
Well, the longer term debt cycle, various time frames of it, but often it's made up of a number of those business cycles, right? And so the exact number can vary, but it can easily take 5, 6, 7 of those business cycles to get to the peak of the long-term debt cycle. And so as an example, the US, in the 50s was not particularly indebted at all. And even in the 60s wasn't, how most households weren't and businesses weren't particularly indebted. And so really it started to pick up starting in the 70s and then really accelerated in the 80s, 90s, and 2000s as interest rates started to fall and the cost of borrowing became lower and lower. And so people took on more and more debt until the point where many took on so much debt that they couldn't reliably pay it back, particularly backed by houses. And so that kind of gives you a sense as to what one of those long-term debt cycles are. And these cycles, you start to talk about cycles, and I think sometimes people sort of look at you like you're talking about horoscopes or something. I think they're just logical series. They're just born of a logical series of events, and a logical series of events that people have played out, through all time. And so you can actually look back and you can say, well, debt cycles existed in the 1800s, they existed in the 1700s. And it's interesting, even if you go back and look 2,000 years ago, there's a reason why things like debt cycles are talked about in biblical times, right? It's because it's a function of how people operate. And so if you can understand how people operate and can understand that series of ways of operating, it can help you understand what's likely to transpire. It's not like it's not a mystical idea. It's a quantitative rule. It's a set of cause effect linkages that repeats over and over again.
So I always equate this to nature and to seasons, in the sense that we're in spring now. Spring is when everything starts to bloom and grow, and summer it starts to peak, and fall everything gets harvested, and then in winter everything, it doesn't die, but it all goes dormant. And if you don't have winter and you don't have the rest, then it doesn't come back to the spring cycle again. And to me, business cycles are just like that. There are times of massive growth in spring. There are times of good times of harvest. Then there are times where people start to fall, right? Things start to get tight. They start to not do so well. And then the good thing is winter seems to always be short. At least it has been in my lifetime, 2000, 2008, 92, maybe 2 years or 3 years of not so great times. And then spring starts to come again and it starts to pick back up. The one thing that's changed is this time around, we didn't have that negative down business cycle. Like, I think had COVID not hit, I think we would have had it, because I think that would have been the natural of what happened. The government printing out and handing out money, I think, totally changed the cycle. It messed with it. But on top of that, if you look at a debt cycle, we had years of artificially low borrowing costs, which caused people to take money at essentially no risk and make extremely risky bets with it. They didn't care. Like, businesses didn't have to think very hard. Let's just throw money at everything because there's no cost of capital. Now all those things are converging. And so first, am I right in that thinking?
Yeah, I think that's right. That through the 2010s, we had a relatively elongated business cycle expansion. Part of that was a function of the fact, frankly, that it took a long time to get the economy going after the financial crisis. And so, how long was the bad period out of the financial crisis to the point where we were finally reaching expansion? It took a long time, as an example, for employment to recover, for asset prices to recover following the financial crisis, and for banks to recover. All of that, there's a lot of healing that was needed, 3, 4, 5 years of healing that was needed before the economy was really positioned for an expansion. And I think you're right in saying that we probably would have had at least some sort of slowdown in the late 2010s, like 2019 or early 2020, were it not for the COVID dynamics. It was a pretty unique circumstance, and that the cycle extended significantly as a function of the substantial fiscal stimulation that the economy received from the government in response to COVID. And so that sort of pushed us into a late cycle inflationary dynamic, which we haven't really seen since the 80s. Maybe that 90s cycle was a modestly inflationary cycle, but really since the 70s and 80s period, we hadn't seen a real inflationary oriented cycle. It's not to say that what we're experiencing right now is exactly akin to the 70s or the 80s, but that sort of dynamic late cycle inflation and the central bank tightening in response to inflation is an unusual circumstance for basically all of us in our professional career.
That it is. So how does inflation change the game of investing? And how does it affect all these cycles? Is there a known path forward?
I think the biggest thing, if you stand in the central bank seat, right? The central bank is trying to balance employment, keeping people employed as much as possible, with ensuring that there's price stability. And price stability is very important. If you go back to that sort of 3-part driver of the economy, the productivity, the long-term debt cycle, and the business cycle, stable inflation, low and stable inflation is very important for long-term productivity gains. And so there's a strategic benefit to have low inflation. And what happens is what we experience, most of us experienced from basically the late 80s all the way until just a couple of years ago, was that inflation was relatively low and stable, which meant that the Fed could respond to slowdowns in growth with stimulative monetary policy. We sort of all got used to that, right? Like growth starts to fall, the Fed stimulates, and we get a rebound. And, sometimes it was a little harder, sometimes a little easier, but that's kind of what we all got used to. The issue with inflation is now that inflation is introduced into the mix, the Fed has a much more acute trade-off between trying to combat inflation and support growth. And given the critical nature that inflation has, or the problem that inflation causes in terms of the long-term stability of the economy, the Fed is likely to fight inflation more aggressively and worry less about employment. And so that's really what we're seeing right now. So far, they've just been catching up. The real tough times come as the Fed starts to say, hey, look, I got to fight inflation. I got to keep interest rates high. I got to accept weaker economic activity and growth in order to fight inflation. And that's kind of the point we are at today, which is the Fed for the first time is probably likely to face that trade-off acutely.
Today's episode is sponsored by Profit Answer Man Podcast. Did you know that most small business owners hate looking at their financials? It's one reason they may struggle with business success. The Profit Answer Man podcast helps them ensure they are profitable and can pay their employees and weather the storms we all have to face. It's built on the Profit First methodology of pay yourself first. The Profit Answer Man podcast is a must listen to for every small business owner and anyone who wants to help them survive and thrive. Check it out on your favorite listening platform. And I think a lot of people, especially early in the raising of rates, thought the Fed was not making the right choices or that there was no need for it, that inflation was transitory. Well, we quickly found out that was not the case. It is not transitory. It is become extremely sticky. And I think people don't realize how long it takes to tame that beast once it gets out, because it starts getting into this ever-feeding loop of circles. Because if you talk about productivity, if you got raises over the last 3 years, I don't think anyone's going to take pay cuts over the next 3, right? They're not giving back wage concessions, which means trying to bring things back in is almost impossible.
Yeah, I mean, inflation is a phenomenon, and that's one of the best ways to think about it, which is the issue with inflation is that there are all sorts of embedded ways in which inflation starts to creep into the economy. So I'm an entrepreneur. I sign contracts all the time. 2 years ago, if I were to sign a contract, there would be a 2% step up or 3% step up after 12 months. That's that was a very normal part of contracts. I'm sure you've seen the same thing in things that you've signed. Today, if I get a contract, it's a 10% step up. Okay, well, that's literally contractually obligated, right? That whereas before it was 2, now it's 10. And so now I'm looking at a circumstance where, my costs are going up 10. So what do I have to do? I have to figure out a way to pay for those costs. And that's the circumstance that, that's where inflation goes from being transitory. It's not transitory. Once it starts to get into all those nooks and crannies, whether it's people's employment contracts, whether it's business contracts, all those different things. And that's why it's self-reinforcing. That's why it's a dynamic rather than just something linear in that way. It's a dynamic that permeates through the economy. And I think, there was a chance that we were going to get through this and have it be transitory. And that's not how it's worked out, right? It's starting to sit in those business contracts. It's starting to sit in the wage growth, the persistent wage growth that folks are getting. And that is, and that those elevated nominal wage growth and expense growth are now causing a continuation of that inflation, beyond just the initial impulse, which was, associated with oil prices rising and some issues related to the supply chain disruptions.
And so, in times like these, everybody looks to the experts. What do the experts have to say? Now, I'm at the age where I remember inflation, but I was too young to really get it. So for somebody to be in that game and really have lived through it and know it, I'm almost guessing that they've got to be around 80 years old.
80 years old, right.
Yeah.
That's the incredible thing, is how many people who are out there professionally managing money, running businesses, have really experienced inflation. And the answer is essentially none of us. Like, I can sit here, as an example, I can sit here and tell you, talk about the 70s and the early 80s, which I've studied at length as part of the process of being an investor and a macro thinker. But I've studied it. I have not. I was not there when in the 70s when inflation was occurring. I don't have that intimate familiarity with that experience, and I think that's the thing that has actually has sort of surprised people so much, is that there's been so little familiarity with inflation that people are a bit surprised at how it's playing out. The stickiness that you talk about, that's very normal if you look back and look at previous inflationary periods, but it's almost a surprise to most people because they haven't experienced it. They've experienced essentially inflation just goes back to 2%.
So in light of that, does the way that we used to invest in the past, just buy and hold and do that, and even thinking, people used to say 60-40 stocks, bonds. Well, all of that blew up this time. Right? It all went wrong because of where everything was. And I don't think even people realize the inverse relationships of bonds and prices and interest rates. When bonds are at 2 and 3% and all of a sudden interest rates go to 8%, that bond becomes almost worthless, which is what happened to the bank that blew up. Is that, not that drastic, but along those lines. How does that change the way we look at investing today?
I think for most savers, the biggest risk that they have is that the prices of the things that they spend on go up a lot relative to their financial assets, right? Because that's why we're all saving money over time, is so that, in the future, whether it's our retirement or college or whatever the things are in the future that we want to spend on, that's what it's all about, is preserving spending power. And so inflation is the biggest risk to spending power. And I think many of us have been trained on this idea of 60-40 stock and bond portfolios, both stocks and bonds do better when inflation is falling rather than when inflation is rising, for the reasons that you describe. And so what's happened is we've been in a period of 40 years of falling inflation. We've all gotten used to things like 60-40 because they've done well in a period of falling inflation. And now the paradigm has shifted to a period of higher than expected and rising inflation, elevated inflation. And so what that really calls to is to say, what types of assets do you have in your savings that help protect you from rising inflation? And the answer is the vast majority of investors don't have any assets in their portfolio that help protect them from rising inflationary environments. So what that means is it's time to start to consider things like gold or commodities or oil as part of a broader portfolio reexamination during this sort of period, because it's those assets that, if inflation falls from here and you hold stocks and bonds, you'll be fine, right? The real risk is if inflation continues to be elevated and you don't have those inflation protecting assets, then you could be in real trouble. If this persists over 5 or 10 years, which is often how long these inflationary cycles can last.
The one thing you didn't mention was real estate. And I find, and I don't think people realize, that real estate is a function of a monthly payment. And so if interest rates go up, somehow things have to adjust. And my guess is, and I could be wrong, real estate prices have to drop. And as it is, they were highly elevated over the last few years.
Yeah, that's right. I think in many ways, what you can think of real estate, it's like an income producing asset in the same way it's like a bond, right? The income it produces is your ability to live in it or the rental income that you earn from it, right? Those are the two sources of income. And so what you see with real estate is in periods of rising interest rates where the payment for the real estate starts to go up, is that the value of the real estate has to go down in order to match the incomes available to spend on it. And so, I think real estate, for a whole variety of reasons, is a beneficial asset to have in your portfolio. It's a way to build wealth over long periods of time. So I'm not saying that real estate should be, outside of your portfolio or anything like that, but it's important to recognize that it would be best complemented with other assets that do particularly well in an environment of high and rising inflation.
Or you were lucky enough to lock in a 30-year loan a couple of years ago, in which case you have an inflation hedge because you're
not moving, right?
You're not moving. Well, or if you had rental property that way, same thing. But yes, you're stuck. Now you can't move, or you turn your current home into a rental property in order to play that game. And people have to figure it out for themselves what works. This is one of the reasons that I've actually switched to tactical asset allocation in the way I do my investing. Can you share a little bit about exactly what tactical asset allocation is and the benefits of it?
Yeah, I think for many people, if you think about the fact that there are different macro environments, right? And different macro environments benefit different types of financial assets. So in certain times, particularly early in an expansion during relatively easy monetary policy, something like stocks or bonds might do particularly well. Or in other environments, like what we're having right now in an inflationary environment, you might see things like oil or gold, et cetera, do well. And so part of the benefit, part of what you can do is build a static portfolio, like that's often where people start. But often what you can do is you can do better than a static portfolio by having some tactical shifts in your portfolio over time that help improve your overall return and protect you from times when a particular set of assets do poorly relative to other assets.
And that makes a lot of sense. I think it's just understanding that what worked before may not work tomorrow, and being able to be open to new opportunities and new ways of doing things. And honestly, when I look at the cycle, I would say this is a very long cycle in that we've been experiencing inflation going down since the early 80s, I'm guessing. So that's a 40-year cycle there, going, turning. And as you said, people aren't used to it and they don't know how to work through it. So I think people do need to pay attention and reconsider how and what they're doing, because what will happen, and I think this is kind of the really deceptive part of this, is tomorrow your investment might go from $100 to $120, and you're like, I'm up $20. But what you don't realize is when you go to spend the $120, it's going to buy you less tomorrow than the $100 did today. And so while you feel like you have more money, it's actually worth a lot less, and you've lost your buying power. And I think it's one of those things that's hidden that we don't see. And I think that's really the biggest problem people will face.
Yeah, I mean, inflation is a tax on everyone that people, don't see literally in front of them, right? And so I think that's why I emphasize when you've shifted from an environment of low and stable inflation, 40 years of that, low, stable, falling inflation, to an environment where we're likely to see, for a variety of reasons, both cyclical and secular reasons, higher inflation. So you have to start to think about how do you protect yourself against higher inflation in your asset portfolio. And that is going to require a shift. It's going to require folks to find assets that are different from what they've learned over the course of the last 40 years.
And I concur. Tell us a little bit. What are you doing today, and what are you working on?
Yeah, I spent a significant portion of my career building proprietary hedge fund strategies, and in the space I like to call it the 2 and 20 space, which is areas like private equity and venture capital and hedge funds. And 2 and 20 refers to a fee structure that many of those funds charge. They typically charge a 2% management fee and a 20% of performance fee. And after years of doing that, it came to me that I wondered whether I could basically take that understanding that I built over the last 20 years and instead of building proprietary strategies, try and create a way so that the everyday investor could have access to hedge fund style strategies. Because, hedge fund managers are pretty good at generating good returns over time. The main issue that, most of those strategies have is that they're not accessible to the everyday investor, and they're also really expensive. The fees are very high. And so over the course of the last year or so, I've been working on building a company, Unlimited, which replicates or seeks to replicate the returns of a variety of different 2 and 20 strategies, and including hedge funds and private equity and venture capital, and put it in an ETF form, which I think is a big innovation, since ETFs are a great structure for many investors. And so that's what I've been working on, building that technology and that underlies our products, and putting out a strategy so that the sort of sophisticated asset management that right now only institutional investors and wealthy individuals have access to, trying to make that available for everyone.
And I think over the years, and people don't realize this, how much, because I remember, going back 40 years ago, if you wanted to buy stocks and bonds, you paid like $300 to make a trade. Today, it's free. The world has changed. More and more opportunities are becoming available, which means you need to be more educated on how to make the right choices, because there is so much, unfortunately, bad information out there, and it's very easy to lose money as well.
Yeah, for sure. I mean, I think part of the idea here is that there are professional investors that spend their entire careers basically focused on how do you navigate challenging market environments most effectively. And so the idea is, could we bring that sort of quality of asset management and make it available to a broader set of investors? And that's really what we're trying to do at Unlimited, is make that sophisticated asset management that many institutions and rich folks have access to and have benefited from, and give that opportunity to the everyday investor through that ETF structure.
That's awesome. It's time to learn the secrets of life. What's your secret to living an abundant life?
Well, I think remaining curious, I think, is the key. I think boredom creates dissatisfaction, and so part of what has driven me through time is constantly being curious, going out and finding and exploring new ideas and new topics. It's kind of why I love macro investing, is because there's always something new, a new frontier, a new area that you don't understand. And it keeps life exciting.
That it does. I've realized I become a lifelong learner, and my problem is there's so many things I want to learn and not enough time. So then it's prioritizing, and I've gotten better at that. What did you learn later in life that you wish you would have learned sooner?
I think a big thing in later in life is recognizing that there's always a draw to a clear path, and that there's a real benefit to a range of experiences. And so, in many ways, our whole structure from the time that we're a kindergartner to the time that we're like 30 years old is go on this track, do this, go to this school, do this. And that, frankly, there's a lot of joy lost and a lot of perspective lost by not opening up the aperture and experiencing a range of different experiences. There's always a time for folks when you have, kids and specific responsibilities where, you do have to prioritize supporting your family and offering your children that stability. But there's a lot of time between, when you're 5 years old and you get to that point where you can, really benefit from that diversity of experience. And so I think for me that was an important lesson that I learned over time, and is, still shapes how I think about the world today.
And I think for kids today, they have to learn to put down the electronics and go experience it because it's made it even harder to do.
Yeah, get themselves dirty.
Get yourselves dirty, yeah. If you were to give an 18-year-old one specific piece of wisdom, what would it be?
It's a good question. I think probably the thing I would recommend for the 18-year-old would be to take on whatever responsibility you can. I think I've seen from people who are the most successful is a hunger and a desire to go out and find and be willing to basically take on whatever they can, help in whatever way they can, even if it's not the glamorous things, even if it's not the things that will make you happy and instantaneously happy, but that process of whether it's in a job or with your family, et cetera, that process, that experience of grabbing things and leaning in, for lack of a better way of describing it, I think is really great because it helps both build that diversity of experiences, right? You're not just stuck on whatever you think is the right thing to do. It helps build your credibility with people who are around you, people who are above you, which is very important. And frankly, it helps you learn faster. And so far too often people are focused on, well, what do I want to do? And not open enough to what can I do to help others in the path, to help others who are experienced around me, and I will benefit from that over time. And so I think that's probably the biggest thing I would tell an 18-year-old today.
I call that leaning into the fear, taking the chance and exploring. Go have fun. And I think that's where I think for a lot of people, we miss our 20s being stuck on a track instead of having the young youth age of just going out and trying different things. And usually at that age, they're so smart, they don't know that the mistakes they're making. So it's easier to make them.
That's right. Yeah, it's way easier to make the mistakes then than make them later. So, but the reality is we can probably make mistakes all along the way, and as long as you've got a good attitude and a learning mindset, you'll be okay. I think that's the important thing, and you certainly. I'm sure you've never talked to someone on this program who hasn't made their fair share of mistakes.
Many, they all have, and yet they still end up successful. If people would like to learn more about your company and their funds, where's the best place for them to check that out?
You can check out our website is unlimitedfunds.com, which has information, a variety of different pieces of information, our blog there, which is about asset management, money management, as well as links to information about our ETF products. And then also for those of you who are active in the Twitter sphere, you can find me at Bobby Unlimited. I'm very active, commenting and discussing what's going on in the macroeconomy in the day-to-day. So definitely check it out, say hello, ask a question. I love interacting with folks of all levels of experience on Twitter. So definitely say hello.
Cool. Thank you so much for joining us today.
Thank you for having me. It was really fun.
If you enjoyed Bob, Google him and check him out on other podcasts he's been on. He's gone much deeper into this subject than we did today. Inflation is going to be a game changer, along with a lot of other macro trends we haven't even talked about. From age demographics to geopolitical to manufacturing, moving back to America, and so many other shifts. The old adage of buy and hold may not serve you in this environment. Neither is buying bonds. 60-40 is probably dead. And as I said, we're going to come back and revisit this in another episode. Here's the reality of it. You need an investment philosophy. And we've covered that on previous episodes. Do you need to reconsider what your investment's like looking going forward? And are you able to tolerate wider swings in the marketplace? A lot of this depends on your ability to generate income from other sources and also your time horizon. Inflation's going to hurt a lot of people because they lose purchasing power and the cost of basic living becomes unaffordable. Add to that a large debt load and increasing interest rates, and you are destined for problems. We are seeing real estate deals blow up left and right, especially in commercial real estate. It's also happening in syndicated real estate. All right. So a lot of these things are occurring. You saw the banks blow up recently. All of this is continuing. We're not done yet. Here's the reality. Your life doesn't have to be this way. You can figure it out. We're here to help. And don't forget to teach your kids about money. By the way, if you enjoyed this episode and you know someone else who would benefit from it, would you do me a favor and share it? I'd appreciate that. Post it on social media. Do whatever you're comfortable with. Think you need to make more money? Well, check out next week's episode. We've got Noah St. John back on to talk about creating the 7-figure life. Thanks for listening. Have an abundant week.